chart in Boeing. You know, you had this high that we talked about earlier in the year. It's been making a series of lower highs. It bounced off of 140. That was very, very big support. In late August, it broke. Now it's come back, but where did it retest and fail yesterday? $140. I think this is a really good opportunity for a retest of those prior lows from last month. And I just want to make one other point. We have another chart of implied volatility option prices in Boeing here on a short dated basis. Look at that. Obviously we're up 100% into that August swoon. They've come all the way back down, and they're actually relatively cheap. And I'm looking to look out and identify the next catalyst, which is going to be their Q3 earnings. I expect a possible miss and a downgrade to forward guidance. So I want to target, it's going to be, I think, October 23rd or 22nd. So I'm going to look out to October 30th weekly expiration. And today, when the stock was $137, I could buy the October 30th weekly 135, yes. 120 put spread for $3. I'm buying one of the October 30th 135 puts at $3.80, and I'm selling one of the October 30th 120 puts at 80 cents. My max risk is at $3 between 132 and 135. I lose it all above that, but I can make up to 12 between 132 and 120.
This is really a trade, I think, that makes a lot of sense here, because I don't think you want to press a short with the stock down from 155 bucks. It's trading at less than 16 times estimated next 12-month earnings. To your point, you might get some guidance that's looking a little bit weaker than that. But it's tough with the stock trading cheaper at a cheaper valuation, and obviously it's been one of the better growers, and it's cheaper than the rest of the market to take a naked short. So I think the best way to do it is probably something like this.
The setup is perfect, though. In terms of what makes an opportunity is a setup, right? So you have well-defined lows at a common level, 140, and a sharp break, 17%, in fact, 140 to 115. And what this is known as is a reaction move, meaning people react to the weakness by buying. People thought it was cheap, some did, or covering shorts. Once a stock throws all the way back to the point at which it initially broke down, which you can see as the lines that Dan drew, it is back at the kill zone. And so you whack it again. It's a perfect entry point for a short.
So you actually approve, you hit Dan's triangle of death.
Well, here's what it is. And you know what I always say, people,
and you can use that if you want.
No, here's what you know how I always say, you can call it whatever you want, because I don't call them anything, because I think that, frankly, is sort of just trying to get attention. But he can do that. But here's what it is. It's not about you. It's not about the triangles. Here's what it is. It's an excellent setup. You have an excellent trade, no matter what you want to call it.
So I actually agree with everything that's on there, but just a few things, by the way. You know it's bear time when you notice Carter again and he starts making sense. I have flashbacks to exactly this time in 2011, and by the way, he doesn't seem to age at all. But with regard to the Boeing trade, I totally agree with the discussion. I think Boeing will have a bad guidance because the dollar is strong, the market is weak, and the Import-Export Bank was not renewed by Congress and will close. And the Import-Export Bank is what we call in other countries a development corporation that gives government subsidies for stuff to be developed and made locally, and all exporters actually use the Import-Export Bank a lot to essentially undo what the European Union and the Chinese do with their own industry. So I think that Boeing will have bad earnings, and this actually makes sense. As a